Good evening, guys. It's Saturday, January 20th. My name is Dave Coker, and this is Talking About Finance. And okay, here we go. This is going to be awesome because we're going to talk about my favorite subject, money. And we're going to talk about making money in a very special way. Not following the crowd and dollar costing into indexes. No, we're going to talk about the power of money you receive. Of money you receive every month, every quarter, every year. And nope, you ain't selling stocks, you're collecting dividends from stocks you own. You see, one of the many problems of putting your money into indexes is you're not creating cash flow. And you have no idea what you're going to be able to sell those indexes you buy today in 1 week's time, in 1 month's time, in 1 quarter's time, in 1 year's time, or 20 years' time. You have no idea. And don't be fooled by those who suggest that buying indexes is low risk. The act is anything but low risk. Don't be fooled by telling you those indexes pay dividends too. They pay dividends, sure, but far less than 1% yield. Can you live off that? Well, if you got 10 million in capital, sure you can. Otherwise, the answer is no. It's very weird, but look at the underlying cause. The greater majority of people pushing indexes upon you aren't educated or experienced in finance. They have no professional background. Instead, they just got into stocks over the past 3 years or so. They haven't been through what we call a full market cycle. They have no idea what it's like to see an index drop over 80%. When I mention this, they often deny it happened. And then I produce a chart showing 2 things. 1, it did happen. And 2, they don't know what they're talking about. So invest early, invest often, invest only for cash flow. Cash flow rules. All right, enough of that. Let's change the subject. Let's talk about finance. The S&P 500 finished up the week about 1.17%. 2 sectors outperformed the index: technology and communication services, just like last week. Another 3 sectors finished in the green, while 6 sectors closed down on the week, with energy and utilities bringing up the rear. The VIX traded up on the week to 13.33, started the week at 12.70. The 10-year note closed the week at 4.13%. It's up 0.2% or 20 basis points on the week and up 20 basis points year to date. Oil closed the week at 73.62, up about 1.3% on the week and down about 2.7% year to date. Late Friday, there were some real speculative plays put in. Basically, that'll pay off only if oil pushes past $80 by first week of February. So watch that. Somebody knows, and these were huge positions, by the way. Somebody knows, or somebody's got a lot of money and they're placing a bet. Not sure what it is, but we do know that a lot of geopolitical tension in the Middle East is really sort of contrary to us seeing the price of oil go down. Sure, the United States is the world's largest producer, has something to do with that, but they can't produce enough for the entire planet. So watch this. This is really interesting. And yesterday was Friday. So you know what I did and how I did it. Yeah, I bought Bitcoin, but the way I've been buying it for about 10 years now, the old-fashioned way. A direct purchase and self-custody. It sounds strange to talk about the old-fashioned way to buy Bitcoin. Who knows? Maybe I'll change my mind in the future. But right now I'm happy. The old ways are the best. Now let's find out what me and 50 of my buddies, finance professionals from all around the planet, talked about last week. And I apologize for my bad manners. Let me introduce us. We are Global Wall Street. And between Telegram and our personal networks on LinkedIn and WhatsApp, we know everyone, absolutely everyone, in global finance. And this week we're reporting from Wall Street. We're reporting from Los Angeles. We're reporting from Miami. We're reporting from Salt Lake City. And we're reporting from Canary Wharf in London. We have people everywhere, absolutely everywhere that matters. So let's go. 7 slides for 7 days. And all right, you money freaks, let's do this thing. Woo-ha! Now, this is an interesting one. We were talking about this on the channel, and yeah, we tended to agree. This is investment bank's philosophy. So investment banking's philosophy. So you do have to keep this in mind. We're looking at various financial products that they pitch. Investment banking is going to make money off of you. Guys, I'm an insider. I'm telling the truth. Investment banking doesn't care about you. Wall Street doesn't care about you. So be very careful taking advice, direct advice from people on Wall Street or investment banking as a profession. And we know that, for instance, interest rates have soared since March of 2022. And we know that purchasing, or debt service, I should say, of companies is really hurting. It's really expensive for them to manage debt like they used to make the debt payments. Now, the Russell 3000 small cap stocks, frequently these are companies that lack the liquidity. They lack the global reach, or the deep pockets, I should say, to refinance other ways. They're dependent upon debt. They can't raise money any other way. And we do know now that there's a lot of zombie companies, and they're starting to die. Yeah, zombies are real in the stock market, but they die, unlike zombies in real life. So this is interesting because it's back to the dot-com bubble level. And we'll have to pay attention to that. It's very, very fascinating to see what's happening. Of course, debt, and you know my opinion of debt. I don't like debt at all. And if you ever wondered if you got a lot of debt, who owns who? Guess what? You are owned by the debt. Debt is your master. You willingly submitted to that master when you took out the debt. So you have to be extremely careful about taking on debt. It's really interesting, the power that debt wields over people and the damage it can do. Because when people are indebted and they don't save for retirement, the rosy picture that they have on the left turns out to be wrong. It turns out to be the reality on the right. And that's fundamentally a problem. That's very disturbing when this happens. And people just take on this debt, and because they got debt now, and I wrote an article recently on Medium where debt can be compared to a time machine. When you take on debt, you're pulling purchasing power from the future into the present. And yeah, when you spend all that future money now, this is your retirement. Not quite what you expected. Of course, an issue is that the Fed is engaged in what's called quantitative tightening now. Quantitative easing was the opposite. They were building up their balance sheet, injecting money into the system. Now they're withdrawing capital from the system. They're shrinking their balance sheet. And they're doing about 1.6 trillion a year. Absolutely amazing, the amount of the amount of money they're withdrawing from the financial system. It's slowing things down, the economy. It's causing all sorts of issues with liquidity. So be very, very careful about taking on new debt, guys. I do expect something. I hate them wrong, but I do expect something. I don't want to quantify it, but I do think there's a interesting chance of something systemic happening, a black swan event. I'm not going to get all paranoid and recite different ideas to you, but the imbalances in the system are phenomenal. It's absolutely incredible. We're seeing what we're seeing in the system right now. It's really wild. Now, one thing you do have to keep in mind is that you have a choice, guys. You don't have to put your money into indexes. You don't have to put your money into dividend-paying stocks. You don't have to put your money in the stock market, the bond market, other markets. You can put some capital into Bitcoin. Check this out. And I did not do this, okay? I don't want to take credit for it. I can't remember who did it. It was on Crypto Twit. Wonderful chart. Wonderful table, I should say. Now, we're going to cut 2010 out. So take a look at the periods, ignoring 2010. And you'll notice something. You'll notice 3 years of green, 1 year of red. 3 years of green, 1 year of red. 3 years of green, 1 year of red in 2022. 2023 green. What about 2024? Well, we all got great hopes. And remember, the halving's coming up roughly May. I believe May 24th is when I've got it figured. I might be off a little bit. But roughly sometime in May of this year, the halving will happen, when the number of Bitcoin produced every 10 minutes drops from 6.25 to 3.75. And if demand remains constant, and we know it should, it certainly will, it's been constant throughout the other halvings, we will see the price of Bitcoin rise, and perhaps substantially. We're just not totally sure, guys. But regardless, when the halving comes, we're going to see something profound happen with Bitcoin. And I know a lot of people price this into the ETFs. I still think the ETFs are going to have a very, very big effect. Right now, we're seeing a lot of selling pressure from Grayscale. I could write a whole article for Medium, maybe I will, about what happened with Grayscale and why Grayscale is selling so much Bitcoin into the system right now, which is, of course, suppressing the price. That's going to come to an end in about 3 weeks. The halving's coming up in about another 3 months after that. Watch out. All right, guys, that's it for this evening. I hope you enjoyed it. Have a great night. We just went out to the pub. We had dinner. We had some drinks. We're going out again. You're going to have a great week coming up. Just remember, be very careful with your purchases. If you're going to deploy capital, know what you're doing and be committed for the long term. Don't try to trade. It's going to be an excellent week. We're all going to make lots of money. Take care.